On this slide, we will delve into the core growth drivers of the company. As you can see, it clearly illustrates how subscriber count and customer engagement propel revenue growth. First, on the left, acquisition strategies directly contribute to increasing the number of subscribers. We can observe a clear commitment to actively attracting new customers through multi-channel brand development, expansion into new specialties and solutions, and strategic partnerships. Next, the central retention strategies are crucial for preventing churn and building a stable subscriber base. The key components here include multi-condition care, clinical excellence, and the provision of specialized content and tools tailored to individual needs. These efforts form the foundation for enhancing long-term customer value. Finally, on the right, engagement strategies aim to maximize revenue per subscriber. By acting as proactive care companions, encouraging the adoption of proprietary products, and tracking health insights and progress, the company seeks to boost service utilization and generate additional revenue. All these strategies are organically connected and synergistically built upon the foundation of personalization at the bottom, driving the company's continuous revenue growth. Let's dive into this slide, which details the historical growth of the company, driven by three core factors: expanding subscribers, entry into new geographies, and increasing revenue per subscriber. First, observe the subscribers chart. The blue bars represent non-personalized subscribers, while the teal bars indicate personalized subscribers. What's striking is the consistent and significant growth in personalized subscribers, rising from 0.8 million in Q2 '24 to 1.7 million by Q1 '26. Notably, personalized subscribers in Q1 '26 grew by a remarkable 20% year-over-year. This is strong evidence that the company is successfully attracting and converting customers to higher value, customized services. Meanwhile, non-personalized subscriber numbers have either remained stable or slightly declined around 0.9 million, suggesting an efficient transition of users towards personalized offerings. Now, let's turn our attention to the revenue chart. The bars illustrate total revenue, and the purple line represents monthly revenue per average subscriber. Total revenue shows a steady upward trajectory, growing from $316 million in Q2 '24 to $608 million in Q1 '26. Specifically, total revenue in Q1 '26 increased by 4% year-over-year. Concurrently, the monthly revenue per average subscriber saw a significant climb from $59 in Q2 '24 to a peak of $85 in Q1 '25, subsequently stabilizing around the $80 mark. This indicates that beyond merely expanding its subscriber base, the company is effectively increasing the value extracted from each subscriber, which is highly beneficial for overall profitability. This slide clearly illustrates how strong and consistent unit economics provide a foundation for confident scaling. First, let's look at the left chart, which shows the payback period in months over the last 5 years. While the payback period slightly increased from approximately 6 months in 2021 to around 8 months in 2023 and 2024, it showed a promising trend of shortening to about 7 months in 2025. Crucially, throughout this entire period, the payback period consistently remained under 12 months, or 1 year. This signifies the company's highly efficient recovery of customer acquisition costs, demonstrating a very effective use of capital. On this slide, we will examine the scalability of our model through the trend of adjusted EBITDA profitability. First, let's observe the flow of the chart. Starting with an adjusted EBITDA of $39 million and a 12% margin in Q2 '24, we saw an impressive peak in Q1 '25, reaching $91 million in EBITDA and a 16% margin. These figures clearly demonstrate rapid business growth and improved efficiency. However, from Q2 '25 to Q1 '26, both adjusted EBITDA and margin show a gradual decline. Specifically, Q1 '26 is projected to have an EBITDA of $44 million and a 7% margin, indicating a significant reduction. While this downward trend might raise concerns, The explanation on the right states that a shift in weight loss shipping cadences presents temporary headwind. This can be interpreted as a short-term impact due to a one-time issue, not detrimental to the long-term growth and profitability of the company's model. Furthermore, the improvement of roughly 300 basis points in market leverage year-over-year and the growing scale enabling investment in leadership and technology talent show consistent investment in long-term growth. Taken together, while the short-term margin decline is noteworthy, the company explains it as a temporary factor and emphasizes that it is securing long-term growth drivers. This slide illustrates the company's vision that new specialties and a more comprehensive personalized experience will position them to scale and accelerate growth through 2026. Let's focus on the trend of the chart. The company's total revenue grew rapidly from $0.27 billion in 2021 to $0.53 billion in 2022, and then to $0.87 billion in 2023. Notably, in 2022, it achieved an impressive 94% year-over-year growth rate. Revenue further expanded to $1.48 billion in 2024 and $2.35 billion in 2025. With guidance set for $2.80 to $3 billion in 2026. While the annual revenue growth rate shows a slight moderation after peaking at 94% in 2022, this is a natural phenomenon as the company's revenue base expands, and the absolute increase in revenue remains very strong. Looking at the detailed breakdown at the bottom, we can see that the service offerings have expanded significantly, starting with dermatology and sexual health in 2021, adding mental health in 2022, weight loss in 2023, and further incorporating labs and hormone health by 2025. This clearly demonstrates that the successful expansion into diverse specialty areas is driving revenue growth and will serve as a foundation to further strengthen market dominance going forward. On this slide, we'll examine how international markets are rapidly transforming into a key growth driver, backed by concrete figures. Looking at the international revenue chart on the left, we see revenue starting at $7 million in Q1 2025, increasing slightly to $8 million in Q2. However, in Q3, there's an explosive growth to $55 million. This upward trend continues with $64 million in Q4, and $78 million by Q1 2026. Notably, the Q1 2026 revenue marks an astonishing approximately 10x year-over-year growth, clearly demonstrating that the investment and M&A strategies in international markets are yielding substantial results. This rapid revenue increase can be attributed to the key milestones shown on the right. The acquisition of Zava in July 2025 played a critical role in the Q3 25 revenue surge, expanding the company's footprint across European markets including the UK, Ireland, Germany, and France. Furthermore, the launch of HNH Canada in November 2025 provides new momentum in the North American market, and the announced acquisition of Eucalyptus in February 2026 signals entry into broader markets such as the UK, Canada, Germany, Australia, and Japan, further boosting future growth expectations. These strategic mergers, acquisitions, and new market entries are firmly establishing international markets as a core growth engine for this company. This slide illustrates key indicators underpinning the company's financial health and long-term growth strategy. First, let's focus on the cash, ST and LT investments trend, represented by the blue line. After reaching $323 million in Q1 25, it surged dramatically to an impressive $1,144 million in Q2 25. This indicates the company successfully secured a significant amount of capital during that period. Although it subsequently declined to $751 million by Q1 26, it still maintains an exceptionally high level of liquidity compared to previous quarters. Next, examining the dark purple bars for operating cash flow and the light gray bars for free cash flow, we observe consistent positive trends until Q1 25. However, in Q2 25, both temporarily turned negative, with free cash flow showing a deficit of $69 million. This anomaly suggests a concentration of strategic investment expenditures coinciding with the substantial capital inflow. Following this, operating cash flow rebounded strongly to $149 million in Q3 25, demonstrating robust operational resilience, and continues to show positive trends through Q1 26. As highlighted in the right panel, the over $750 million in cash and short-term investments provides the company with critical flexibility to opportunistically deploy capital for new opportunities. The stable cash flow profile enables ongoing infrastructure investments, and the $225 million remaining on the $250 million share buyback program clearly signals a strong commitment to shareholder returns. Overall, this company is successfully leveraging its strong balance sheet to reinforce its long-term growth trajectory. This slide presents a highly encouraging outlook for 2026, highlighting the company's anticipated accelerating growth profile and consistent adjusted EBITDA generation. Let's delve into the financial figures. For Q2 2026, revenue is projected to be between $680 million and $700 million, indicating a robust year-over-year growth rate of 25% to 28%. For the full year 2026, the company targets $2.8 billion to $3.0 billion in revenue, maintaining a strong growth trajectory of 19% to 28%. Regarding profitability, adjusted EBITDA is expected to range from $35 million to $55 million in Q2, and between $275 million and $350 million for the full year. A particularly noteworthy trend is the adjusted EBITDA margin, improving significantly from approximately 7% in Q2 to around 11% for the full year, indicating increasing operational efficiency. These positive projections are supported by 5 key underlying themes. Firstly, an impressive long-term customer retention rate of over 85% suggests a stable and predictable revenue stream. Secondly, strong unit economics with a payback period of less than 1 year points to an efficient business model and quick return on investment. Thirdly, the evolving business model inherently drives marketing efficiencies, leading to cost-effective customer acquisition. Fourthly, the HIMS brand is expected to reach $1 billion in revenue, signaling a powerful growth engine within the company's portfolio. Lastly, international expansion is becoming a material incremental growth driver, opening up significant future growth opportunities. All these factors combined position the company for substantial growth and improved profitability in 2026. Now, let's examine the company's capital investment focus for 2026, which centers on unlocking access to higher quality and more personalized care. This strategic direction aims to serve millions of individuals with improved healthcare access. First, we see a strong emphasis on international expansion. The acquisition of the Eucalyptus healthcare platform is set to significantly broaden their geographic reach, solidifying their global leadership position. Importantly, this acquisition is projected to be a key driver in scaling annual revenue to over $1 billion within the next 3 years, demonstrating clear financial growth ambitions. Second, the company is focused on the rapid scaling of its data intelligence layer. This involves leveraging lab data to unlock deeper customer health insights, enabling individuals to identify potential conditions even before symptoms materialize. Furthermore, the planned verticalization of at-home blood draws with YourBio is a strategic move to enhance their data-driven personalized healthcare capabilities. Third, the acceleration of new specialties is a crucial growth area. They are expanding to serve customers across different life stages and successfully launched more new specialties in 2025 than in any prior year. Each of these new specialties is expected to represent a future $100 million annual revenue opportunity, signaling significant potential. Fourth, the company aims for an increased breadth of personalization. This includes developing new form factors and multi-condition treatments to offer more tailored solutions. The incorporation of lab diagnostics supports more comprehensive care, and they are expanding facility space and sterile capabilities to further enhance service quality. Finally, we look at strategic investments and relationships. The company is pursuing partnerships to enable access to innovative cancer screening and proactive care. Notably, their relationship with Novo Nordisk is expected to significantly accelerate their trajectory in the weight loss management market, highlighting a key strategic alliance for future growth. This slide presents a reconciliation of net loss income to adjusted EBITDA, a crucial financial statement for understanding a company's true operational performance. Looking at the revenue trend, it steadily grew from $315.6 million in Q2 FY24 to $617.8 million in Q4 25, before showing a slight decrease to $608.1 million in Q1 26. The most striking indicator here is the net loss income. While starting with a profit of $13.3 million in Q2 FY24, it dramatically shifted to a significant net loss of $92.1 million in Q1 26. This sharp turnaround to a substantial loss within just a few quarters sends a critical signal to the market. In contrast, adjusted EBITDA, while generally more stable, also shows a declining trend in recent quarters. After peaking at $91.1 million in Q1 FY25, it fell to $44.3 million in Q1 26. Although it remains positive, this nearly halving from the previous quarter is a concerning development. Investigating the reasons behind the Q1 FY26 net loss, we can observe significant increases in one-time and non-recurring expenses, restructuring and other related charges at $33.5 million, legal settlement costs at $15 million, and acquisition and transaction-related costs at $13.4 million. Furthermore, a provision for income taxes of $9.4 million was recorded, contrasting with benefits in prior quarters, which also contributed to the net income deterioration. This analysis shows that the net loss in Q1 FY26 was largely driven by one-off expenditures and items typically excluded when calculating adjusted EBITDA. However, the significant reduction in adjusted EBITDA itself signals a weakening in the company's core operating cash generation, warranting close monitoring of future performance trends. On this slide, we will deeply analyze the reconciliation of net cash provided by used in operating activities to free cash flow, observing how these crucial metrics fluctuate over time. First, let's examine net cash provided by used in operating activities. This metric clearly indicates how well a company's core business is generating cash. From Q2 FY24 to Q1 25, we saw a consistent positive trend, increasing from $53 million to over $109 million, demonstrating robust operational cash generation. However, a significant dip occurred in Q2 FY25, showing a temporary cash outflow of approximately $19 million, which could be attributed to operational factors such as inventory buildup or delays in accounts receivable collection. Fortunately, Q3 FY25 saw a dramatic rebound, reaching an all-time high of over $148 million, and this strong performance continued into Q1 26, exceeding $89 million, indicating a return to stable cash flow. Next, let's look at the investment-related expenditures. Purchases of property, equipment, and intangible assets, along with investment in website development and internal use software, represent the company's essential capital expenditures for future growth. We can observe a very significant increase in CapEx from Q4 FY24 through Q3 25. In Q3 FY25 specifically, the company spent over $65 million on property and equipment alone, clearly indicating substantial strategic investments aimed at securing long-term growth drivers. While such investments can pressure short-term cash flow, they are crucial for enhancing long-term competitiveness. Finally, let's turn to free cash flow, FCF, which synthesizes these components. FCF represents the cash remaining after a company covers its operating expenses and essential investments for future growth, reflecting its discretionary cash-generating ability. FCF was strong in Q2 FY24 and Q3 24, but it slightly declined in Q4 24 and Q1 25 due to the increased capex. The most significant point to note is the substantial negative FCF of over $69 million in Q2 25. This was a direct result of negative operating cash flow combined with massive capital expenditures. However, in Q3 25, a powerful rebound in operating cash flow enabled the company to restore positive FCF, even amidst its highest capex. Although FCF temporarily turned negative in Q4 25, it converted back to a positive $53 million in Q1 26, regaining a solid footing. This volatility can be interpreted as a complex interplay of aggressive investment strategies and temporary adjustments in operational cash flow, and investors should closely monitor whether these investments yield long-term growth.